this is Rena Jada for Vader News, and today we are going to talk about cashing out, exits, and valuations. Our guest today is Randy Hawks, who is the Managing Director with Claremont Creek Ventures. Randy, welcome to the show.
Well, good morning, Rena. Glad to be here.
So tell us a little bit about Claremont Creek Ventures.
Claremont Creek's an early-stage technology investor. We're focused on the East Bay corridor of Northern California. Have about $300 million under management, and we focus on three primary markets: IT applied to healthcare, IT energy management and conservation, and thirdly, security and sensor-based networks. We like to say we turbocharge the uncommon startup and help them get to success.
Very nice, and very hot sectors, no less. So how bullish are you on liquidity and exits in 2010?
Cautiously optimistic is the way to say it. I think as we entered the year, the reports I saw from investment bankers said 40 to 50 IPOs this year for tech-backed or venture-backed technology companies. My guess is we'll probably see half that, which is still an improvement over 2009, but I expect third and fourth quarter to be a little bit less positive than we initially thought.
And what are the milestones that a company needs to go through to get through that IPO window?
Well, there are really two kinds of IPOs. There are the financially driven companies, and there's the companies that are going public based on a story, and there's still a few of those. For the financial driven companies, it's typically 4 to 5 quarters of profitable growth. You want to see maybe $100 million or better revenue line and a continued growth curve better than 20% growth annually going forward. For the story-based companies, there are those cases where you own a new market, you created a new segment, you dominate the market space, and the world, the public market, believes that that's going to be a large market over time. So we'll probably see a couple of those make it out as well.
Do you think Facebook and Twitter will make it out this year?
I think Twitter's probably a 2011 story. Facebook is certainly on my short list. I would think Facebook, Zynga, LinkedIn, Yelp, all those companies have pretty good positions and are doing great at realizing their revenue. And on the product side, everybody knows Tesla in the electric vehicle market, so I think we'll see those. I bet Twitter is more of a 2011 play myself.
Let's talk valuations at exit in an IPO. I mean, some of these companies like Zynga, LinkedIn, their pre-IPO valuations are in billions. What do you see them IPOing at?
Well, that's a great question. My crystal ball is really sort of fuzzy there. I like to say that's above my pay grade. Those kind of companies that have large valuations today, $1 billion, $2 billion, I think Facebook's last round, I remember, was $11 billion when they sold some stock. It's clearly going to be in the multiples of that. I'm not sure how you drive the financial metrics to get much above 10 or 11 billion for those companies. So I don't have a hard projection for you. The better situation, frankly, are the product-driven companies where you can base it purely on revenues, and there you can run the traditional investment metrics on either a multiple of revenue or a multiple of earnings to match to the high-growth markets that have traditionally gone to NASDAQ. And
what multiples would those be?
Well, so in earnings, if you're a profitable company with earnings, you can see 20 and 30 times your PE ratio on a multiple of sales. Depending on the market sector, 4, 5, 6 times sales, and in some really hot sectors, you can even get up to 8 or 10 times sales. Well,
Randy, parting shot. Tell us, what is your advice to entrepreneurs out there that are building for an exit?
Well, for any entrepreneur, mid-stage or building for an exit, have satisfied customers who sing your praises. Build big market momentum, because you need that to get exit. People have to believe the story continues. And then for any private company, take all the private capital you can raise, because it always takes longer and more cash than you expect. So take the money when it's available.
Isn't that the truth? Randy, thank you so much for sharing insights. And everyone else, thanks for watching the show.